Welcome back, you guys. And yes, we are continuing our conversation with Fulu Makwetla, Third Way Investment Partners. And we are having a Bue Chair with a difference this time because we are at her office and I got to behave myself because there's many other really important people that are walking these corridors. But we're going to wrap up our conversation now about funding, perhaps in a way that you and I can relate as entrepreneurs, because we often see funding in various ways. And for somebody that's always been in the business of putting capital into businesses, exiting businesses, and seeing the role of capital, I think it's quite important to get a perspective. So Fulu, thank you very much for sitting down with me in what we call the Bue Chair. And this is really about getting into now your headspace and your own experience about this issue of funding. When you started your business, you come from the capital markets anyway, so you clearly had a very deep understanding of what funding means. Many of us sit and wait for the funding before we start. How did it work out for you?
Well, it's not that easy. So you work with other people's money. And now when it's time to take the leap of faith to say, I can do this myself and run my own business. Remember, I've always been employed by someone. I've always earned an income. It's always been a guaranteed income. We knew that bonus time, this is what is expected.
Oh, yeah.
You knew how you would participate in, bonus structures, carry structures, and so forth. And now here you are, starting it afresh. So you go in there with some fear. You go in there with some understanding of what it will take. We were fortunate, or I particularly was fortunate somewhat, that we were able to raise funding from a shareholder.
Right.
And so we had a shareholder loan.
So, and let's talk about that, right? When the shareholder comes into your business, if you indeed go with the equity option, whether you're in the PE business or any other business.
Yeah.
If I'm saying, all right, now I want to raise capital from a shareholder, I want somebody to buy into my business.
Yeah.
The big issue is valuations.
Yeah.
Right?
Yeah.
Talk to me about how do I make sure that as an entrepreneur, I don't sell myself too short or price myself too high?
Well, the thing about valuation is that it depends on where in the business you are. So at the start of our business, of course, if there's a shareholder, the shareholder is going to take equity in the business. And so I am not the only equity holder of the business. And so we have to agree on that. We have to agree that I'm also going to work in the business. And so I'm going to earn some sort of income. But I'm also a shareholder, so I have to look at the long term of the business. And so when we think about valuations, we have to think about valuations. I guess there's three ways to value valuation methods. There's the basic valuation method, which says, what is the cost? And usually that valuation method would be used for things like replacing a property, for example, if you own a property and so forth, and that's how you would apply that kind of valuation, or even for infrastructure businesses. Then there's, of course, the market valuation to say that if you are selling tiles or in the tile business, for example, what would be the comparable business in the tile space if it's listed, and what would be a precedent transaction if that's happened recently in the unlisted space.
Basically what someone else paid another person for a similar business.
So if a tile business in the unlisted space was being sold, what was the sale price relative to what you're selling yours at this point in time?
That's valuation
so that's
method
number two. And then there's, of course, the discounted cash flow method, which is what is the future forecast of the cash flows of your business going forward.
And the third one seems popular, though.
It is popular, and it makes sense for various reasons and various types of businesses. And so it has to be, especially in private equity, if you're looking at what is the future cash flow of the business. So your business today, I may have certain customers or certain number of investors and customers, and I'm going to grow that business. So what does the market look like, and what is it that I'm going to expect in the future? So we need to determine a price today of what the business will be worth in a couple of years' time based on what we expect the future cash flows to be. And so that's probably a more, and that's why it's probably popular, because it's more in line with what is the expectation of the business in the future.
But with the discounted cash flow method, I may have a very wonderful view of my life. You know, I'm the entrepreneur. I always think my business is better than perhaps the next person.
Yeah.
You may come as a potential investor in the environment where I'm looking to raise equity financing.
Yeah.
And you may go, Andile, no, bro, this forecast of yours is a little too perky.
Yeah.
That creates obviously friction now, right?
Of course. We are always subjective when it's our own businesses. And this is why there's the importance of having an independent person value your business. So I, as the buyer, will do my own cash flow analysis. You will do your own. And we get an independent party to do an independent assessment of what that value of the business is at.
Right.
They give us a number, and somewhere
between your
number and my number,
and the independent
there's
number,
a guidance from the independent number as to where you should sit. We should be able to find each other. And if we're unable to find each other, unfortunately, that's probably where the deal falls flat.
Okay, so that's equity. Before I move away from equity, timing is also important, right? So if I sell too early, I may sell my business too cheaply. If I want to hold on until maybe it's worth more, it may never get there if I need the funding. How do I make that decision of, am I selling too early? Should I just push a little bit more so that I can convince, Fulu and their team at Third Way that, it's worth more so they can pay me more?
Yeah. It's always, there's never the right timing, but what I said earlier is that James Clear says that nobody ever says, I should have done it later. I should have done it earlier. So everybody needs to consider doing it right now. If your business is ready for that funding, go for it. Go for it.
Let's go to debt.
Yeah.
How do I know if the right funding is debt, or if the right funding is equity for my business? Is there a technical way of determining that?
Yeah, it depends on the type of business that you're in. It depends on the funding that you have gone to seek.
Yeah.
So, for example, we are in the infrastructure space.
Yeah.
And we particularly fund the debt side of things. Yeah. And so in our business, we understand that there's less equity in infrastructure. So the debt to equity ratio is usually about 70-30, maybe 80-20.
And so 80
being debt.
Okay.
And 20
Why is
being
that? Is that because
equity.
of the infrastructure nature, the assets?
It is the nature of the assets. Yeah.
So if you're more asset-heavy business, you probably have a better chance of raising debt.
Yeah, that's it. There's more debt required in the business. And also, in some instances, for example, you can only, if you are a private equity business, for example, you would only be able to fund equity. And then you would then go and look either for a mezzanine partner to fund the mezzanine, or else you go to the bank or other debt funders to fill in for that gap. But a lot of times you find that you can't really leverage or put too much debt in your business.
Right.
Or you might have too much equity in your business that you actually need to leverage the business to grow it using debt.
I see.
And so there are times when your business does actually require more debt than it does equity if you have sufficient equity funding.
Right.
So it depends on the nature of the business itself.
Okay, so and then the type of businesses, you're saying it depends on the nature of the businesses. So if I have a very kind of asset-heavy business, right? Let's say it's a transport business or a trucking business.
Yeah.
I guess in that instance, because debt generally is cheaper than equity, it perhaps makes more sense that I go to a bank and I asset finance the trucks.
Absolutely.
As opposed to go raise equity from somebody selling a share of my business to buy trucks.
Absolutely.
Whereas if I'm perhaps in a business that's not very asset heavy, maybe a professional services environment where I'm funding salaries, I may need more equity to fund that business because I may not be able to raise the debt.
That's correct. You've hit it on the nail.
Right.
So that's the nature of the business I'm referring
Pricing.
to.
Let's talk pricing.
Yeah?
The cost of the money. Equity generally is expensive. Other than the emotions of losing a portion of my business, generally, equity investors like yourself are looking for bigger returns than mostly debt providers.
Absolutely. But I think the nature of equity itself is that it's volatile. It's a long-term investment.
Okay.
And so in terms of ranking, if you think about it, equity is probably regarded as a long-term asset class. And so you expect that you would get your return on investment over a longer period of time. And there may be periods where you expect high growth, and there are periods where there is no growth. And so you have to have the time and the patience for the equity. With debt, with cash or money market, for example, you find that, it just outperforms inflation. And so in pension funding, for example, our clients are looking to invest across all asset classes.
Right.
So where they put in equity, they're expecting a higher return, but it's patient capital. They're also investing with you for a longer term. The money market investments that they make, they're expecting it's just to hold money.
Absolutely.
For other, for liquidity purposes when they need to pay pensions and to move money between asset classes when required.
Yeah.
And then the fixed income, your property, for example, property being a separate asset class on its own, has the equity component as well as the debt component. Yes. And so it too requires a little bit more time, but it does have that cash flow that it returns to you. And then the debt, some clients are looking just for a stable cash flow coming back to them, and that's why they would give you the debt. And so equity is expensive for that reason, that it's a long-term asset class. It can be volatile, and so you need to give it time to perform. Yeah.
Fulu, let's leave it there. Let's wrap it there. Thank you so much for your time, and thanks for inviting us to your wonderful offices. We promise we'll put everything back the way we found it.
Thank you so much.
All right, you guys. I hope you really enjoyed that, because it's very important for you to make the right funding decision, and the funding types are also quite important. Hopefully, Fulu was able to shed some light on the options available to you.